Okay. Hello, everyone. So today we're going to be focusing on rent, rent expense, rent income for the business. So basically, rent is when um, you rent income is when you are renting a building to somebody, it's like additional cash for the business with rent income. And then with rent expense is us renting the premises that we are doing our undertakings in. So it becomes an expense because it's something that we use to make money, basically. So we're going to start with the first question, right? So this one is a rent expense question. So they say that a storeroom was rented from 1 June 2025 at 11,200 per month. Rent increases by 7.5% on the 1st of December 2025. Provide for outstanding rent. So the 79,240, it's telling us that this is not the complete amount that we should have paid, right? So then we have to account for the amount that we're supposed to pay, right? So the first thing that we're going to do, we're going to lay down our months, right? We started renting the storeroom on the 1st of June, right? And the financial year started on the 1st of March, right? So I'm going to do it like this. I'm going to say June, July, August, September, October, November, right? These months, how many months? 1, 2, 3, 4, 5, 6. 6 months we're paying 100%, right? And then December, Jan, Feb, right? These 3 months we were paying 107.5% because rent increased, right? So what's the initial amount? The initial amount before the increase was 11,200, right? So what are we going to do with that 11,200? We're going to multiply it by 6 months because we paid it for 6 months, right? And the total answer would be 67,200, right? Now, the amount in question is the 7.5% increase. How do we calculate increase, right? For this 3 months, we're going to take this 11,200 and then you're going to multiply it by 107.5 over 100 to get the amount, the 7.5 increase full amount, right? Inclusive of the initial amount. And then that amount will be 12,040. What do we do with that 12,040? We're going to multiply it by 3 months, right? Because we paid it for 3 months. We're supposed to pay it for 3 months. And then the total answer gonna give me 36,120, right? So we're gonna do this. We're gonna sum it, right? The summation of this, the summation of the 6 months and the summation of the 6 months and the 3 months is the total rent expense that we're supposed to pay for the year, right? However, we only paid 79,240. That means that we should calculate the outstanding rent, right? So 67,200, forgive me for the currency, plus 36,120 is equals to this is the amount that we're supposed to pay, which is 103,320. What are we going to do with this amount to find the outstanding? We're going to subtract the amount that we have already paid, 79,240. So our outstanding amount would be 24,000 right? So this is the amount that that's outstanding. This is the amount that we're supposed to pay. So effect on the income statement. So this is an expense, right? It's an expense. Let me put this on the side. Right. So this is let me underline it. This is an expense. So under operating expenses, you're gonna write rent expense, right? And you're gonna write the initial amount that we paid, 79,240, plus the outstanding amount, 24,080, because it happened during the financial year, right? It happened during the financial year. So we have to include it, right? And then effect on, even though we did not pay it, we have to include it on this on statement of financial position, and that would be, so basically this is rent expense, right? And what we're saying is that we did not pay the outstanding amount, right? So it's gonna be an accrued expense, right? An expense that we have not paid it. However, we have to account for it because this expense took place this financial year. So under trade, current liabilities, trade and other payables, you're gonna account for the outstanding amount, which is 24,080. You're gonna account for that. It's an accrued expense and it's payable because we haven't paid it. And yeah, it's easy as that. Yeah, just break it down. As I said, you break down every little information they give you. Okay, so the second transaction that we're gonna look at is rent income, right? So basically it's the same concept as rent expense. However, this is an income to us, right? It's the money that we make it on the side, right? Besides the sales. Okay, so basically, we're gonna read the information as always, and then we're gonna break down the information, right? So it's just two sentences, right? So they're saying our rent for March 2026 has been received and recorded. Note that rent was increased by 750 on the 1st of February 2026. So they're telling us that we paid the rent for the next financial year. So we have to remove it because it did not it took place this year. However, it's operations for the next financial year, operations for the next statements, right? So what we're gonna say that we're gonna start with the months. Every time with the rent, we start with the months. We note down the months, right? So this 274 500 is inclusive of March, right? It's inclusive of the month March. That's the first information they give us, right? So they're telling us that from the 1st of March 2025 to the 31st of January 2026, rent was normal price, right? And then from February, it increased by 750, right? So they're telling us that 11 months, it was 100%. And then from February, since this is inclusive of March, we're going to say for the 2 months that this money is inclusive of, for the 2 months, it increased by 750. So we want to clear out this 750 to get a clear idea of how much rent was initially. So we're gonna say the 750 times 2, which is 1,500, and then you're gonna subtract this amount from the 274,500 minus that amount, so that we can get a clear picture of how much initially was this rent. Then I get 273,000, and then now we can divide it, right? So we're going to divide it by 13 months because it's an addition of March. Divided by 13 months, I get 21,000. That means for the 11 months, we were paid 21,000 for rent, right? But in Feb, it increased by 750. So we have to add back the 750 because for March, they paid 21,000 plus 750, which is 21,750. This is for March and Feb. However, we're focusing on March because it's not part of the financial year. So effect on income, just gonna say IS, income statement. Under rent income, rent income, right? You're gonna subtract from the 274,500, you're gonna subtract the 21,750, right? Since it's a deferred income. And then effect, let me just so that we can see, effect on statement of financial position, SF. This is my own abbreviations, guys. Under trade and other payables, which are current liabilities, trade and other payables, you're gonna add this 21,750 for March, right? Because it's payable. They might demand it anytime because they haven't used the space yet, right? So we might pay it anytime back because they haven't used the space yet. And that's it. That's it for this transaction. Okay, this is the third transaction. This is our last one. So it has a paragraph. Don't be scared by the paragraph. It really means a lot, but it means nothing in terms of complexity, right? Anyone can do this. Right? It's fine. So they say rent. It's a rent income. Rent has been fixed for the past 2 years. On the 1st of June 2025, a deposit of 4,950 was received upon the occupation of a second office at the same rate. So what they're saying is that another office was rented out, right? However, this money that was received in June was a deposit. They're hinting to us that, they paid a deposit June, they paid a deposit for this second office. And they're telling us that the second office is the same rate as the first office, right? So we're receiving the same income for it. It's just that we received an additional deposit, which is 4,950, right? Rent for March and April 2026 has been received for both offices. There's a big note. The deposit is included in the rent income. So this 154.95 is inclusive of the deposit. What do we do now? We're going to subtract this deposit immediately because this deposit won't let us find the exact amount that these two offices are worth, right, in terms of rent. So the first thing we do, we're going to say 154,000 4,950 minus 4,950. Then we get 150,000. Right? Now we have to find out what is this 150,000 consisting of how many months, right? So the first office was obviously rented for 12 months, a full 12 months. However, March and April was included. So this means the first office is 14 months. 14 months was paid. The second office was rented in June, right? So June, July, August, September, October, November, December, Jan, Feb, and March and April, right? It's out of our this year's capacity. However, we have to include it because this money, the 150,000 consists of it. So it's 11 months. So you're gonna add the months together. I get 25 months. Therefore, I'm gonna take the 150,000 divided by 25 months to get the exact amount, the exact rate that we pay, that they're paying, 6,000. Right? So now I need to get that full amount that I'm gonna subtract, right? So it's the 6,000 for March and April. However, we have two offices, so it's gonna be 4 months. So 6,000 times 4 is equals to 24,000. It's out of the capacity of this year, right? So we're gonna subtract it. So the effect on income statement, firstly, it's the rent income. So we're going to subtract, okay, let me do it step by step. We're going to subtract the deposits, and then you're going to subtract the 24,000 because it's payable. It's for the next financial year. And then the effect on the statement of financial position, did I say SP the last time? I hope I did. It's going to be payables, right? Trade and other payables. Trade payables. You're gonna add this 24,000 because it's payable, right? They might want it anytime, and that's basically it. It's a deferred. Sorry, it's a deferred income. 24,000. It's a deferred income. Okay, so that's it for the rent adjustments.